Have you ever seen the market break a high, only to snap back and drop like a stone? Or dip below a low, then launch in the opposite direction? That move is no accident. It's called a liquidity sweep, also known as the swing failure pattern, or SFP. In this video, we'll explore what an SFP is, then go through the rules that make it valid. From there we'll look at how to manage trades effectively and filter only the highest probability setups. And finally, we'll highlight the most common mistakes to avoid, so you can trade liquidity sweeps with confidence. If that's something you're interested in, make sure to hit the like button to show your support, and subscribe to the channel if you're new here. The market loves liquidity, it hunts stops. And where do most traders place their stops? Right above swing highs, and right below swing lows. An SFP happens when price pushes through a prior swing high or low, triggering stops, but then closes back inside the range. That's the sweep. The rejection is the reclaim. And the strong push in the opposite direction is the displacement, that's your reversal signal. But there are few rules that make a setup valid, to know exactly what to look for before taking a trade. First, identify liquidity. Look for a clear prior swing high or swing low, ideally one that stands out on the chart, or a cluster of equal highs or lows. Second, wait for the sweep. Price must wick above the swing high or below the swing low. That's the stop hunt. Third, look for the reclaim. The candle must close back inside the range, usually within 1 to 3 candles, signaling that the breakout has failed. Fourth, wait for displacement. Watch for a strong move in the opposite direction, large candles, imbalances, or fast momentum. That's your confirmation. Now, when it comes to entries, there are two approaches. Aggressive traders might enter as soon as the reclaim is confirmed. Conservative traders wait for clear displacement. They look for a confirmed break of structure or a change of character on the lower timeframe like M15 or M5. Entry is then taken on the pullback, once price retests the broken level, providing a more secure and higher probability setup. Which one you choose depends entirely on your risk appetite. If you're willing to take on higher risk for a better reward, the aggressive entry gives you the best price. But if you value confirmation and prefer a higher probability setup, the conservative entry is the safer option. There's no right or wrong, it's about aligning the entry style with the kind of trader you are. Once you are in a trade, management is key. You don't want to treat all trades the same. Stops go just beyond the wick of the sweep, with a small buffer. If you're trading with clear confluence and higher timeframe alignment, you can aim the opposite liquidity pool for TP1, and any strong higher timeframe level for TP2. Always look for at least 2 to 1, ideally 3 to 1 risk to reward. Not every sweep is a good trade. A valid swing failure pattern only matters when it forms at important areas, like support and resistance, supply and demand zones, or along key trend lines. These levels act as magnets for liquidity, and that's where sweeps carry real weight. And after the sweep, you need to see displacement. Look for a strong, impulsive candle or a series of candles driving in the opposite direction. That shows genuine rejection. If the market barely reacts after the sweep, it's usually best to skip the trade. The best setups happen when what you see on the lower timeframe lines up with the higher timeframe. For example, you might notice liquidity swept below a recent low on the 15-minute chart. But when you zoom out to the 4-hour, that same sweep is tapping directly into a major support or demand zone. That confluence makes it a much higher probability setup, because price is rejecting from a critical higher timeframe level. Timing also adds reliability. Sweeps that occur during session opens, like London or New York, tend to have more momentum and are more trustworthy than those that happen in quiet hours. At the end of the day, filtering your setups is about quality over quantity. Focus on fewer, stronger SFPs instead of chasing every move. By doing so, you'll find your results become more consistent and far more reliable over time. Now let's go over the most common mistakes traders make, so you can avoid them and stay ahead. When trading swing failure patterns, beginners often fall into the same traps. Treating any pin bar as an SFP. Remember, it's not just the wick, you need a close back inside. Another mistake is entering too early. Traders often jump in right after the sweep, without waiting for confirmation. That impatience leads to being trapped on the wrong side when price keeps running liquidity further. A third mistake is poor risk management. Swing failure patterns look clean, but they fail too. Placing oversized positions or moving stops too tight will almost always backfire. Remember, risk management protects you even when the setup doesn't. Another common mistake is ignoring higher time frames. Many traders get caught up in the 1-minute or 5-minute chart and forget that real liquidity is built around higher timeframe levels. If you only focus on small moves, you'll end up overtrading weak setups. Finally, many traders lack a playbook. They take trades randomly without rules. But successful SFP traders keep a defined checklist: entry trigger, risk to reward, higher timeframe alignment, and session timing. That consistency is what separates pros from amateurs. Here's a simple playbook checklist, make sure to save it or take a screenshot. Keeping this by your side will help you stay disciplined and consistent throughout your trading journey. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon so you never miss our next video. If you have any question, drop it in the comment below. Thanks for watching, see you in the next video.